think all of us, some of us are just, we love the holidays. So if it's just one day, I'm sure we can use it, especially for those of us who are in Lagos and other part of the hustling, bustling part of the country. So I guess we're just waking up from yesterday's one-day holiday. So it's good to see everyone here on behalf of Cowry Asset Management Group, Investment Banking and Securities Trading Company. I had the pleasure of welcoming everyone to today's event, which is the quarterly economic review. Actually, it's about the second half of the year, so it makes sense to look back and look forward. And I had the privilege of being here again for another time, kindly invited by Mr. Johnson Chukwu and the rest of his team to anchor the program for the next 1.5 hours or thereabout. So good afternoon, everyone. Welcome to the program. Let's just do a very quick one by standing up and taking the anthem of the Federal Republic of Nigeria. If we have it coming through from the system, would you kindly launch the anthem of the Federal Republic of Nigeria? Thank you. A second or two.
Nigeria, we hail thee, our own dear native land. Though tribe and tongue may differ, in brotherhood we stand. Nigerians old and proud to serve our sovereign motherland. Our flag shall be a symbol that truth and justice reign. In peace or battle honored, and this we count as gain. To hang on to our children a banner without stain. O God of all creation, grant this our one request. Help us to build a nation where no man is oppressed. And so with peace and plenty, Nigeria may be blessed.
Thank you. Please be seated. Thank you so much. I saw a number of folks searching out on Google the anthem and using their phone to follow through. That is allowed. We all want to be in tune. We want to appreciate all our attendees and delegates who are joining us online for this particular event, the quarterly economic discourse, thriving in a volatile economic environment. We want to make this as business as possible, even though we have online community watching, and part of this will also go on television, as you can expect. This, if you consider the size of the room, is a private briefing. And Cowry Asset Management is one company that makes money without making noise. I make noise, so I don't make money. But Johnson Chukwu and the rest of his team make money, they don't make much noise. But if you consider the ambience here, you'll understand why these diversified financial markets, regulated by the SEC, licensed by the SEC, and also under the registration of the Nigerian Exchange and others, has decided to bring us together. Let me say a very big thank you to Johnson Chuku. Let's give him a round of applause. Please pardon me because we've gotten so used to each other on television that he has become like a show anchor. I just say Johnson Chuku. I hardly even add Mr. any longer. I hope you pardon me, the Managing Director and CEO. Thank you of Cowry Asset Management Limited. Let me recognize, and in no particular order, and please permit me to defer to the market where I was raised by recognizing Mr. Jude Chiemeka, the CEO of the Nigerian Exchange Limited. Please give a round of applause. Thank you very much for coming. If you allow me to stick in the Market Street, I will also recognize Professor Uche Owaleke, the Director, Institute of Capital Market Studies, Nasarawa State University, KEFI. Thank you, Professor. I was also a former official of the SEC, and is bringing quite a lot to the discussion on the panel in about an hour from now. Please permit me to recognize Mrs. Yinka Adeleko, the Managing Director of Augusto & Co. And the man I'm recognizing, last but not the least, is also someone that I've known for so many years, at least 20 to 25 years of my career. He's one of the individuals I've interviewed the most in the private sector. The founder and CEO of Center for the Promotion of Private Enterprise, CPP, former Director General of the LCCI, Dr. Muda Yusuf. He's the only man who dressed like the man of the people here. All right, I want to say thank you to other directors and top executives of Cowry Asset Management. I'm not sure I can recognize everyone. Mr. Johnson Chuku is the chief marketer and the CEO of the organization, so he's the one that his face is so common on television, wherever he is. So let's give them a round of applause, please. Directors of Cowry Asset Management team, thank you very much for being here this morning. We're going to have a very quick opening remarks, then of course the keynote address, but let me quickly allow Mr. Charles Sonny, the Managing Director of Cowry Treasurers Limited, that's the man who keeps the money, to give the welcome address, every welcome address. Thank you. You have the floor, sir.
Good afternoon, distinguished guests, esteemed colleagues, partners, and friends. It is with great delight and pleasure that I welcome you to this edition of what was formerly known as the Cowry Quarterly Economic Review webinar, which has now evolved into what we proudly introduce as the Cowry Quarterly Economic Discourse. Today marks a significant milestone in our journey. Not just a change in format, but a bold transition into a more inclusive, more dynamic, and more impactful platform for engagement, insight, and collective action. What indeed began as a modest virtual review of economic data and trends has now matured into a hybrid forum where digital reach meets physical connection, where data meets dialogue, and where economic theory meets real-world decision-making. This transformation reflects our deeper commitment to driving meaningful conversations around the Nigerian economy, the African context, and the global trends that shape our financial future. It also mirrors the evolution of our brand and the clarity of our mission. At Cowry, we are driven by a powerful purpose to transform lives using the power of wealth creation in a world where financial instability can often cloud human potential. We believe that access to the right tools, insights, and strategies can unlock extraordinary outcomes for individuals, business, and the entire community. Our mission is therefore to create exceptional wealth for all our stakeholders, not just in monetary terms, but through empowerment, education, and long-term financial growth, which is why we have our footprints in wealth management, mutual fund operations, securities brokerage dealing, financial advisory, issuing house, savings and loans, consulting, and real estate through different subsidiaries. Today's discourse has been designed to provide clarity in the midst of economic volatility. From inflation and exchange rate fluctuations to fiscal policy shifts, such as the tariff war, geopolitical conflicts, and global macroeconomic pressures, there is no shortage of questions confronting investors, institutions, and everyday citizens. But in every challenge, there lies opportunity, and in every disruption, there lies the seed of innovation. In setting the tone for today, we aim to achieve three things. First, illuminate the current economic landscape with expert insights and reliable data. Two, engage our audience, both in person and online, in vigorous and rigorous thorough discussion. And thirdly, inspire purposeful decision making, aligned with the ultimate goal of sustainable wealth creation. Shortly, we will hear from Cowry's Group Managing Director, Mr. Johnson Chukwu, whose keynote presentation will provide a strategic overview of the local and global economic environment and help contextualize our discussions. Following this, we will engage with thought leaders and key stakeholders who will expand on the implications of today's trends for tomorrow's opportunities. I encourage everyone, whether you are a policymaker, investor, entrepreneur, or professional, to participate actively, ask questions, share perspectives, challenge assumptions. This platform exists not just to inform, but to empower. Once again, thank you for being part of our journey. Let us make this session not just another meeting on the calendar, but a meaningful step toward a more prosperous and economically empowered future. Once again, thank you, and you are welcome to the Cowry Quarterly Economic Discourse. God bless you.
Oh, thank you. Thank you so much, sir, for raising the curtain on this investors briefing, in the manner of speaking, which is a quarterly economic discourse. Actually, is bringing the economy together to the market, find a meeting point. But the bottom line is how investors can look into the economy, look at the opportunities, look at the challenges, find how to make money, how to create wealth, and at the end of the day, we all get better. So by now, I think we all get used to the volatility somewhat. Let's listen to the group, the founder and group managing director of Cowry Asset Management. Please put your hands together for Mr. Johnson Chukwu.
Thank you. Good afternoon, everyone. Good afternoon, ladies and gentlemen. Good afternoon, all our guests. Good afternoon, I can say princess. I'm still looking out for Coyote. When I got in here and I saw Bosin and I looked at the height, I said, we also have somebody as tall as him. But Coyote must come here. Please, you guys should call him. So that he doesn't live here with be the tallest man in the hall. So, permit me to stand on the existing protocols. Let me also appreciate Bosin, who at short notice accepted to anchor this. And then all our discussants. On first call, they all accepted. I will start mentioning them individually. Yinka, we've come a long way, that reality. I'm sure we've known ourselves more than 30 years. Same with Yusuf Muda. In fact, I called him to come and pay a debt because I used to do this for him. So we've also come a very long way, over 2 decades. And my brother, Chiemeka, um, in fact, I didn't even call him. Watch out, I mentioned it to him. I said he was coming. I said, "Are you sure?" He said he will come. Thank you, my brother. And then our own man, for as a matter of disclosure, Professor Uche Waleki is the director of Cowry. So, obviously, sometimes they say familiarity breeds what? I just assumed I had told him. And I circulated the list of the speakers. And then we moved on. A few days to the event, Patrick told me, "It's like you didn't tell, did you tell Professor Waleke?" I said, "Really? I just took it for granted I've told him, or I didn't call him." So I called him. And then he said, "No problem." By then, he had already gotten his name, picture circulate. So once again, apologies. And then I have my directors here. I have Mrs. Boma Alabi, SANON, a director of Cowry, is one of our independent directors. And I have my other senior colleagues. You've already met Chasani. He's also executive director in the group beyond Dublin as the MD of Cowry Treasurers. And then we have Nkole Edoka. She's the MD of Cowry Securities. And so I don't take all our time. I have some of my senior management staff here and every other person here, including those who joined virtually. We had to limit the number of people here because of the space. So we asked most of our colleagues to join us virtually. We also limited the number of people we invited to come here physically because of the space. So I guess a lot of people are online, and some of the people we have reserved seats for, maybe they think, like Bosin said, it's an extension, the holiday is still on. So once again, Bosin, thank you. It's a long relationship we've had, and we cherish you. So I'm going to speak, like I promised Yinka and Chiemeka that this won't take more than 2 hours. So even the time we spend waiting to start, I've counted into the 2 hours we are spending here. So I'm going to speak on thriving in a volatile economic environment. The global environment has been so volatile in the past 5 years. In fact, somebody said that the world changed after COVID, and the world has not been the same after COVID. But beyond COVID, we also had series of factors that have distorted the global economic environment. So just go to the next slide. And so if you look at the world economy map, as a map of the world economies, you will observe that 2 economies alone account for 40% of the global GDP. The US at 24.4% and China at 15.6%. If you sum up the two, those 2 countries account for 40% of the global GDP. The 10 top economies in the world account for 62% of the global GDP. So, and that's why the turbulence we are facing today, the volatility we are facing today, has actually heightened when a quarter of the world economy began to impose tariff on the other economies, and then with the likely implication of shrinking global trade as well as spiking inflation figures, inflation rates. So you observe the kind of turbulence we had when those announcements were made on Liberation Day of April 2nd was quite huge because Mr. Trump imposed huge tariffs on China. And like I said, the 2 economies alone account for 40% of the global GDP. So what are the contributors to the global economy in the first volatility in the first half of this year? These are the major factors: Trump politics and tariff war. Of course, from the day Trump was sworn in, even before he was sworn in, he began to make statements on the tariff he was going to impose. Then on April 2nd, day he called Liberation Day, he imposed tariff across all economies, including their closest trading partners. In fact, he started picking the fights with his closest friends: Canada, the European Union, Mexico, and then On second, he imposed tariff across, and the countries he didn't have to add any additional tariff. He just added 10%. Of course, uh, the world economy went into a major turmoil. He came back on April 9th, and I said he was going to defy it by 90 days. And the key thing is that tariffs, we know, have impact on price levels, have impact on, because anything that affects price levels affects demand. Anything that affects demand affects production. And whatever affects production affects the GDP. And whatever affects production also affects employment. So you have a chain of events that those announcements triggered off. But if we're just talking of the first half of this year, like I said, the world changed in 2019. You have seen the global economy has faced too many turns and twists, too many turmoils since 2019. 2019, we had to deal with COVID-19, which actually hit Nigeria in 2020. And then, subsequent to that, we saw as the world was coming out of the COVID crisis and the economy was being restored, we saw Russia invade Ukraine in February 2022. And that led to another crisis in terms of supply chain. The European NATO countries imposed tariffs, ban on importation from Russia, particularly importation of Russian oil. Or Russia cut off gas supply to Western countries, and then blocked the Black Sea, made it difficult for Ukraine to export its cereals. This led to a major spike in food prices around the world, major spike in energy prices. The global economy went into another convulsion within that time. And then, as we thought we were coming out of that, then we were hit again by another political crisis when Hamas invaded Israel on October 7, 2023. Just barely a year and 7 months or so after the start of the Russia-Ukraine war. And then this year, on June 13th, as the world was also coming out of that, on June 13th, Israel attacked Iran, and then that war evolved. Of course, good thing is it was a short-lived war. Some of us actually predicted it was going to be a short-lived war because Iran did not have a major power supporting it. But that was not even why the war was ended quickly, because Israel did not contend with the level of capacity of Iran to hit back Israel. So, and the Israeli Prime Minister couldn't stand a situation where the homeland was being hit by rocket from Iran, and knew that would have turned the tide against him. So he had to pull back from that war. So, and again, in terms of policy environment, you cannot say more than enough of what Mr. Trump has done with his tariff announcements, which has continued. This week we had an additional announcements. So we're going to go to that. So what are the implications of that? Of some of the first of all, starting from COVID, when I say the world changed with COVID, we are still trying to go back to the same level of price levels. We've not gotten back to that. We are trying to go back to the same level of energy cost. We have not gotten back. Even Western countries, England, the standard of living had deteriorated, security had deteriorated, cost of living had gone up in almost all economies of the world. So you see the implications of distortions on the global economic outlook, the confidence of investors. If you look at the bar chart, the blue bar chart, you will observe that just before COVID, crude price, and I'm using crude price as a proxy to measure the level of confidence of market operators, economic agents. The simple reason that when whatever happens, investor will ask, will it affect production? Will it affect demand? And then whatever they think will affect demand, they will affect the production. Then they will slow down on demand for energy inputs, which is crude. So you see, during the lockdown, crude averaged $27. This is the average price. At some point, it was trading at negative prices when people who had their crude vessels laden with crude were looking for markets and had to beg, sell, ask people to be paid an amount or paid a fee to take the cargo. So, but eventually averaged, but when the lockdown ended, it went back to $73. So that will show you the severe impact. Of course, I guess everybody in this hall can remember the lockdown, even as it affected the country. Then you can also see the average crude prices all those years. You can see the lowest was in 2020, apart from the periods where you had global recessions like you had in 2015. If you look at the bar chart to your right, um, this is the impact, how the market reacted to Russian invasion of Ukraine. Immediately happened, the Western countries imposed ban on importation of Russian crude, and then we saw crude trend 1 week after the attack. You saw crude at $123 per barrel. Of course, after 1 month, it moderated a bit, and then you also saw the impact on Nasdaq. Then this is just to show you what has happened this year as it relates to next slide, as it relates to prices. You can see the fluctuations in crude prices, particularly Brent, which mirrors our Bonelite. So you can see whenever there is, you can see the spike when Israel attacked Iran. You can see the spike when Donald Trump, you can see the drop immediately. Donald Trump announced his tariff. We saw crude price trade out in the region of $60, $62. So you can see on the gold side, you can see gold has continued to appreciate as investors run away to safe havens. So you can see that consistent increase in gold prices. The other crude oil, the WTI West Texas Intermediate price also is moving the same direction as Brent. Then, what are the implications of this? Prior to the beginning of this year, the IMF and World Bank came to the world and made their annual announcements on global expected growth in the global economy. For instance, they said the US is going to grow this year at 1.4%. First quarter of this year, US grew only at 0.5%. It said Japan is going to grow at 0.7%. First quarter, Japanese growth was flat. He had projected that UK will grow at 1.08%. First quarter, it was 0.7%. You can see China. It was projected that China will grow at 4.5% this year. The first quarter, it grew at 1.2%. So this is just to show you that. And look at India. India is actually the fastest growing big economy in the world. It projected that it would grow at 6.3%. India grew at only 2%. This will show you that the implications of the economic policy pronouncements are affecting global economic activities. Nigeria figure, the 3.6 was based on the last quarter of last year. So Donald Trump making a bad situation worse. The man's statements, the president's statement have continued to create upheavals in the market. If you look at what he said on Jeremy Powell, the Federal Reserve Chairman, he said the ECB is expected to cut interest rates for the 7th time, and yet too late. Jeremy Powell of the Fed, who is always too late and wrong, yesterday issued a report which was another typical, complete, messy, and messy. He said oil prices are down, groceries, even eggs are down, and the US is getting rich on tariffs. Too late, should have lowered interest rates like the ECB long ago, but he should certainly lower them now. Powell's termination cannot be fast enough. Immediately he said that, the financial market went on a gyration. So, again, he said on the monetary policies, and that was what he said just this week. Today is 16. On Monday, he said, I'm looking to replace Jeremy Powell as Federal Reserve Chair with someone who will prioritize American first policies and strengthen our economy. What happened? Bond prices, Eurobond prices went down. Immediately announced that. So what he's saying in effect is that he's going to control the fiscal policies and control the monetary policies. And every central bank in the world was modeled around the US Federal Reserve on the basis that the Federal Reserve Chairman is independent of the executive. But the man is tugging and subtracting from that This morning we woke up and saw bond prices nosedive because of that statement he made on 14th. Then on the Iranian war, we have to edit out some of the things where he said sometimes it's good to allow them fight. When the world, he said he said to the world that he's an easy target, but he's safe there. We are not going to take him out, at least not for now, implying that he still plans to kill Ayatollah Khamenei. He said, but we don't want missiles shot at civilians or American soldiers. Our patience is running thin. Of course, he eventually bombed Iran. Then, just same Monday, he said on Russian war with Ukraine, we are very, very unhappy with Russia, and we're going to be doing very severe tariffs if you don't have a deal in 50 days. That's if they don't stop the war in 50 days. Tariffs at about 100%. They call them secondary tariffs. That is an addition to existing tariffs. That's why he said they call them secondary tariffs. He now said that any country that continues to do trade with Russia will face a big tax to sell their products to the US. And then on BRICS, then on tariffs again, he said goods imported from the European Union and Mexico will face a 30% US tariff rate starting from August 1st, 2025. Canada will face a 35% tariff rate on all import from August 1st. EU and Mexico, and July 10, 2025. Then Canada. So that's what he said on, I think on Saturday. And then he had also told us, as partner nation to BRIC, that any country aligning themselves with the anti-American policies of the BRIC countries will be charged an additional 10% tariff. There will be no exception to this policy. So what were we saying? So almost on a daily basis, the president that controls 25% of the global economy comes up with something that distorts the market. In fact, my colleague and friend Charles Stanley said this morning, until this travel arrives and lives here, that you wake up yesterday, we traded on some Euro bond, and then I said to Charles, good yield, take position. And then this morning he came back to me holding his head on his hand. I said, what's the problem? He said, market had tipped because of Donald Trump's pronouncements. And you wonder how a president has all the time to be tweeting. But anyway, let's come home. So you look at Nigeria's macroeconomic review. We're going to look at what has happened in the first half of this year, and then we'll look at look a peep and what we think will happen in the second half of the year. This is the GDP figures at the end of last year. If you observe, you look at this, you see that our GDP grew at 3.4% last year. It grew at 2.75% the preceding year. And if you look at that, you find out that agriculture accounts for about 25% of GDP activities. You see information and communication technology at 17.6%. And then you see trade at 15%, and then manufacturing at 8%. The key thing we have to look at, if you look at the top 5 biggest contributors to the GDP, you will observe that apart from ICT and finance and insurance, the rest major hitters are growing at very sluggish rate. You see agriculture growing at 1.19%. So you can see there's no brainer in what is driving food prices high in food inflation, because population is growing at faster than the rate at which agricultural productive activity is growing. You see, like I said, ICT is an exception, grew at 5.4%. But look at trade, which accounts for about 15% of our GDP, grew at only 0.95%. And you look at manufacturing, that should be the one producing the goods and services we are selling. We are consuming, it grew at 1.38%. So finance and insurance was the strongest performer. Then if you go down, you will observe something that is of concern to me. The arts, entertainment, and recreation sector, which is employing a lot of our youth, the entertainment, the Davidos, the Thames of this world, that sector is shrinking. Because, and I'm sure if you look at those who attend, the younger people who attend gigs, you will observe there are a few gigs nowadays. People can afford to pay for those things. In the past, they do events in a cohort and the people pay for table for 1 million naira. I'm not aware that they've had many in the past couple of months. So that is affecting that entertainment industry, which we thought will grow to become a major competitor or a major contributor to the GDP. So if you look at this, um, you observe that the in terms of GDP growth rate, of course, we know many of us are familiar with this. You've seen the GDP had contracted twice under the regime of the president that just passed on. Um, and I asked my son, what are the young people saying about the president? I'm sure you don't want to hear that. But because they are in the social media and they were saying their things. But this is just to give you where we're coming from. Okay, the GDP inflation was debased. Inflation had actually peaked at 34.8% in December last year, but after the debasing, which took effect from January, the debasing entailed that they used the average inflation rate for last year as a base for this year, and then we've seen inflation moderate. At the end of May, it was at 22.9%. We've seen all parameters moderate. So you have the food inflation is actually moderating faster. Of course, part of why the food inflation is moderating is that if you are like me that eat a lot of maize, and when you eat maize, you won't eat anything that night. Uh, and it has come out too. Are you not chopping it? So, so you find out that a lot of this is the peak of the harvest season. So people, there is a lot of food that we produce from our farms, and that's what is driving down food inflation. So we hope that trend will continue. And on the core inflation, we've seen some level of stability in the exchange rate, and that has flushed into core inflation moderation. Then if you go to the next slide, you'll observe that in financial terms, we say that because inflation rate is higher than the yield on fixed income instruments, that you're actually suffering negative real return on investment. But we are seeing moderation in inflation rate, and we're also seeing, if not that we are, interestingly, we've also seen moderation in the last week on Treasury bills yield. We saw 364-day bills sold at 16.3%. But prior to that, we were seeing a narrowing in the negative real interest yield. I still believe that the central bank will reverse the current depression in yield and fixed income instrument because there is another compelling factor which we'll come to. So now looking at what are the factors that are showing the bright signs in our economy, you look at the trade factor. If you look at the export and import, you will observe that our exports in the first quarter, the first blue bar on the second corridor, is export for the first quarter of this year. If you look at that, total export was 20.5 trillion naira. Total import was 15.4 trillion naira. We had a positive balance of trade of about 5 trillion naira, which ordinarily, if we continue in that trajectory, it will flush into reserve. It will flush in the ability of the central bank to manage the FX and the exchange rate. So you can actually see consistent improvement in exchange rate. If you look at the pie charts, you will observe that China has become so important to this country, and I hope the government has to find ways to deal with this because for me it's becoming a threat where a country accounts for 30 billion of total imports. So if there is a shutdown or supply chain disruption in China today, we're going to have a major inflationary impact on the country. So government needs to consider that. I know Western countries are already doing a lot of things to diversify their productive base from China, and they are moving to India, moving to Vietnam, to make sure that after the COVID lockdown, that what happened will not happen again. But interestingly, in terms of export, you can see India as our largest export partner. You have followed by Netherlands. Of course, what we sell to these countries are largely crude, because if you look at our total export, the blue bar chart, you see that crude and mineral-related items, crude, then you have liquefied natural gas, you have other gas commodities account for 85% of total export. So you can see the other contributors to our export, vegetable products about 2%, and then you have spirit. tobacco, which is exported to West African countries, largely about 7%. And then our import of petroleum products, about 33% of our total import, has actually moderated slightly after Dangote started producing. The implication of improvement in balance of trade, as well as the government, central bank's active involvement in selling of money market instruments, has actually led to some appreciation of the local currency. I understand I have 5 6 minutes more, so I'll just quickly wrap it up. So we've seen Naira appreciate. As at Monday, the official rate was in the region of, last week it traded about 1518 last week, and then we've seen at the private market it came as low as 1530. So, of course, we know our borrowing has continued because revenues of government has been weak. So we saw an increase in national debt by 47 trillion last year, and then another 4.7 trillion naira in the first quarter of this year. Shows our GDP to debt to GDP ratio. They tell you that we see comfortable, but the problem is that our revenue to debt service to revenue is a problem. So, but even at that, we've seen an increase in debt to GDP to 52%, and we have the list of. I'm going to send this so that you can look at the list of the most indebted and least indebted states. Economic policies affect every other parameter. These are the major economic policy pronouncements of the federal government. Subsidy removal, we have talked a lot about this in the past. The implications are that we're going to show that we also have so what the government did was they removed subsidy on both fuel and foreign exchange. And the implications are, we saw a major spike in inflation rate. We saw, like I said, we saw inflation rate peak at 34.8% in December. Food inflation had actually peaked at about 40.87% around May last year. But those factors have begun to moderate, which we talked about. We also saw a spike from FX regime. The official window was about 423 naira, 430 naira. At the official window when the exchange rate was harmonized, and the parallel market was in the region of 700 and 720 naira. Then we saw it peak at about 1,900 naira, the parallel market rate, and then we have seen the moderation I've just talked about. This is just to show you crude production. We're seeing crude production improving, and we believe it will continue to improve in the coming months. FS reserve. Well, the central bank has been very active in intervening in the market to maintain market stability. So we've seen the central bank, offer treasury bills at yields that are attracting foreign portfolio investment, and also using those funds to intervene in the market to stabilize the exchange rate. So that has also negatively affected our reserve because of the level of CBN intervention. Then this may pass as one of the landmark achievements of the current government. Because we don't have time, we're not going to dwell on that. Of course, with the 4 laws that constitute the tax reform bills have all been passed into law. They are supposed to harmonize Nigeria's tax laws, create a uniform legal and operating framework, establish an autonomous and performance-driven national revenue agency, and provide a governance structure to ensure cooperation among revenue authorities. So these are some of the hallmarks of that law. But the one that will affect some of the big men here is capital gain tax, which has been moved from 10% to 30%. So when you sell your property, you pay 30% of the gain. But unfortunately, Nigerians, I hope the tax system will be able to. Okay, so then let's quickly go towards our take on what we think. Well, this is just to show you the capital market had gained, as of yesterday, had actually gained 22% so far this year. And then at the end of the first half of this year was about 21% gain. We had the sectorial performance, where the consumer goods had the largest gains of 52%, and then you have followed by the banking sector, and then followed by the insurance sector. So these are the major, and then you have the oil and gas sector as a laggard with a loss of 10%. Then these are the major gainers and major losers. I'm sure when Chiemeka is talking to us, maybe he'll tell us about the underlying factors driving. No, no, go back to the first. Yes, you can see Beta Glass had gained 414% this year, followed by Honeywell 241% gain. I remember when my wife told me to buy, she wanted to buy Honeywell, and I said no. What do you? But after that, she said I have to pay her for the loss. So you have no Honeywell at 241%. You have the initiative PSA. I'm sure some of you are asking what's initiative PSA. This is a waste management company based in Oyibo. So they've gained 230%, Vitafoam 221, Nimet 185, and then on and on, Fitzin, Presco, Champion Breweries, Square, and Chelaram. Then these are the laggards. You have the laggards, you have VFD, lost 68%, Sunu Assurance, 52%, Conoye, 39%, Unicel, 32%, MRS, 24%, Veritas, Gillot Beja, and all the rest. So, and Golden Green Breweries, I don't even know that they are still producing. Okay. So, under factor, we have to recognize that we've seen improvement in foreign portfolio investment into the market. Good 18, the head of the market is here. So you've seen, if you look at the May figure, you will see the improvement of 118 billion improvement inflow from foreign portfolio investment in the market, and you can see year to date. You can see that 118 is more than about twice what was what we got in April of this year, and also about twice what we got in March this year. Look at the February figure. So what's happening are the currency appreciating? Foreign portfolio investors also recognize the fact that they come in, they make capital gain, they also make exchange gain. So once your currency is stable, it becomes easier to attract foreign portfolio investment into your securities instruments. Then bond yield, we've seen bond yield move southwards as prices go up. Then you have the treasury bills. The treasury bills, the federal government has used, the central bank has used the treasury bills as a major tool to sustain FX stability. So we've seen consistent offers, and because of the yield, which is quite attractive, we've also seen a lot of bid. So far this year, the central bank has sold 8.7 trillion in treasury bills and about 9.2 trillion in OMO instruments. Total sales of OMO, treasury bills, and bond is about 22 trillion so far this year. So let's quickly look at the outlook so I can yield the ground to the panelists. Well, this is our outlook, or what we think will happen. Oil price, we expect oil price to average about $67 per barrel. This is predicated on the fact that OPEC has committed to increase crude production by about 548,000 barrels a day at a time when Donald Trump is using tariffs to shrink economic activities. So if you have a shrinkage in demand, at the same time you are having an increase in supply, you are certainly going to see a moderation in crude prices. So we are projecting for the second half of this year, crude price will average $67 per barrel. Of course, you could see some level of fluctuation. We think Nigeria's crude production will increase about 1.65 million barrels average. Of course, that makes allowance for the fluctuations you may experience. We know with the acquisition of Mobile by Seplat and the Renaissance acquisition of Shell assets, so we expect that they will reopen some of the shut-in wells, and this will lead to some improvements. So excluding condensate, which is about 250,000 barrels a day, we should expect average crude production about 1.6 million barrels. We think GDP will average about 3.7% this year. We think it will be some level of acceleration even as the GDP is rebased. We think inflation will moderate down further to about 20%. Why do we think so? We think exchange rate stability will subsist, and then food production will only be the leg that we have to deal with. as we move out of the harvest season. Then, in terms of reserve, we think reserve will be in the region of $38 billion dollars at the end of the year. And we think average exchange rate for the second half of the year will be in the region of $1,525 as central bank actively participate in the market. And then equities market, we think the return will range in the region of 30% this year. And based on the fact we've already done 22%. And of course, you're going to get a point where you call support level and resistance level. So those things will make the level of gains we've seen. So we think it could range between 25 and 35%, but averagely about 30%. And then we think interest rates will go back beyond the 16.3% that we saw last week to the region of 20%, because the central bank needs high interest rate to continue to sustain interest of foreign portfolio investors. Otherwise, the pressure will come back on FX. And finally, tips for surviving economic volatility. One, for businesses, anticipate change, plan for change, execute your plan. They said a bad strategy effectively executed is better than a good strategy badly executed. Build scenarios, develop contingency plan, diversify your revenue sources into unrelated sectors. Be an early adopter of technology. Diversify your currency risk. Diversify geographical and sovereign risk. Diversify product offerings across different income strata. So you have the defensive product you sell to the low income earners. You have the high end products you sell to the high income people. And then for individuals, upscale your competence level. Develop secondary income, even if it is farming, or a beauty or grooming business, or fashion and provision store. Get a secondary income that will add to your day pay, and invest your savings in income earning assets. Not just enough to say I've saved. That savings must generate you money, and diversify your portfolio. Local and foreign currency instrument. Today you have mutual funds. You can invest in dollar-denominated instruments at small amounts of money. Then explore joint venture or collective investment in real estate, as real estate remain very defensive asset class. Thank you all.
Please keep it going for the professor. Keep it going for the professor. One thing Mr. Johnson Chukwudi didn't mention was if he was diversifying his skills into anchoring or TV anchoring after having done hundreds of interviews. I think by now that could be, I'm not sure how much income it will fetch, but but you know, but very interesting. Let's give him a round of applause. Thank you so much for breaking it down. I think we're walking a very tightrope, and let's be honest with ourselves, on the basis of the economy. I have tears in my eyes looking at some other African countries, looking at the numbers we brought out, and how much we're locked into what we call an oil resource-based economy, and we haven't really diversified. Now, gold is selling for about $3,300 an ounce. As of yesterday, Tanzania's tourism has overtaken the country's gold exports as number one FX earner. $3.3 billion so far this year in tourism alone, without counting gold exports for Tanzania. Where is Nigeria's tourism? And what's the size of Tanzania and what we have here? In terms of coffee, Uganda and Ethiopia both are making close to $3 to $3.5 billion so far in coffee exports this year. Where is our coffee? So we have just 2 or 3 products out of the oil sector, hydrocarbon, that can fetch Nigeria roughly, by this time, first half of the year, we should be talking about $10 billion in non-oil exports just from 2 or 3 products only. So what we have here, and I love what you said, if your oil price estimate is 62 to 65, I'm not sure we can do 75 next year for next year's budget, because even the IMF has asked us to take our budget back to the drawing board based on where we are today. So even if we produce 2.5 million barrels per day, like Kazakhstan and others, at current prices and geopolitics, I'm not too sure we're in so much money. But it is what it is. Let's ride on that very impressive presentation. Let me invite my panelists to just come forward to the podium. Please put your hands together, ladies and gentlemen, for my first panelist, Mrs. Yinka Adilegon, the Managing Director at Augusto & Co., which is a Pan-African credit rating agency with operations across Nigeria, Ghana, Kenya, and Rwanda. She has more than 2 decades of experiences in financial analysis, and she has led ratings of over 800 billion naira in debt instruments and steered the company through expansions across the continent. Thank you very much, madam. It's good to have you here. Let me introduce Mr. Jude Chemeka, the Chief Executive Officer of the Nigerian Exchange Limited. More than 30 years of experience spanning securities trading, asset management, former CEO of United Capital, Raincap, and Chapel Hill Denham Securities. He's also well-heeled in the market. Now, let me also invite to the podium Professor Uche Waleke. Please put your hands together for Professor Waleke, who is the president of the Capital Market Association of Nigeria, and of course, who is the director of the Institute of Capital Markets at the National State University, and of course, an ex-SEC official. And of course, Dr. Muda Yusuf. Please put your hands together for the founder and CEO of the Center for the Promotion of Private Enterprise, CPP, and a former Director General of the Lagos Chamber of Commerce and Industry. Let me invite Mr. Johnson Chukwu to join them. You fire the salvos first, so please join the panel. Thank you very much. Now I got the team complete. I think it's a little bit of trying to see how to handle this because you've stated it all. But let's start from the only female panelists. I'm sorry, madam. Yes, I think so. Yes, please, if you wouldn't mind. Yeah, it's called Trading Places. It's an old movie. If you're old as I am, then you must have watched Trading Places. Okay, so let me start with you, Mrs. Adilekan. When we talk about the policy environment, just raise the curtain for me for 2 minutes. What are your takeaways from Johnson Chukwu's presentation?
Okay. First, I'd like to say things are moving for Nigeria positively. One of the things I was going to talk about was what it has taken a lot of government in Nigeria to do. It took this current dispensation of political leader to come in and say they're removing all subsidy, which has changed the dynamics of things for Nigeria significantly. If you ask me, Dangote refinery would not be as successful, even though, we haven't seen the figures yet, as it is today, if not that the oil subsidy was removed. Because now it's able to trade at market reflective prices. What it would have been contending with would have been margin shrinkage. So in my view, the removal of oil subsidy, which a lot of administrations have tried to do but couldn't, it's a game changer for Nigeria. There's still other things to be done. There's increased poverty levels, insecurity, but I think we're on the right path, and I think I took that from Johnson Chukwu's presentation.
Thank you so much. Now, one of the things we need to do, madam, thank you. Please give a round of applause, please. We appreciate that. I'll get my panelists fired up. Let me ask Jude, I'm sure you see it where the foreign portfolio investment flow goes, but one of the things we'd like to see is foreign direct investment as well, which is also good. What more can we do, given the current global economic volatility? Much more can we do to attract foreign direct investment?
All right. First, let me start by thanking Cowry for inviting Exchange to be part of this conversation. I think if we think about the reforms we have seen so far It's really helped with the portfolio investment, and the figures, I think year to date, it's almost 30% up. Um, we have a market in the past that used to be 50-50 international, 50 percent domestic. But because of the weak macro FX challenges, that figure fell to 4%, right? And the year before last, it was 11%, and then last year was 15%. So we're beginning to see the benefits of the reforms on the foreign portfolio investment in the country. And so, to your question around direct foreign direct investment in the country, I think the presentation that we saw from Mr. Chuku clearly identified all the positives and the sectors that are growing. But I think we also need to talk about security because apart from the macro, apart from the policy reforms, I mean, security is a major concern, and I think that is one area that we really need to focus on. Um, we can see the benefits of agriculture for us. I mean, food security is a matter of urgency for not just for Nigeria but for most African countries. And we do have a very viable assistance in terms of Dangote fertilizers. I mean, if you haven't been to Dangote site, I think you should make an effort to go there. Don't rely on what you read. It's about 7 times Victoria Island. If you're fortunate enough to explore and just have a view of what has happened there, it will first of all make you to understand that truly as Africans we do have the capacity and we do have the ability to. And he has been talking about in recent times. He has been talking about Africa rising and how Africa can actually position itself to become they are in a position to be able to look after themselves. So I think security. I also think that more reforms. Yes, the FX reforms, the harmonization of the exchange rate has helped. Removal of subsidy has also equally helped. But I think we need to invest in education as well, because if you're talking about foreign direct investment, they need to work with when they make those investments, they need to work with people. And we're not talking about just manual labor now. We're talking about skilled labor. We're talking about the AI era and technology. And so that area is one that I believe we need to take more steps to ensuring that we have the right people in the economy to be able to do that. But beyond that, this ability for returns is also very, very key. If we look at all the sectors that are thriving, you can see the food and beverage stands out clearly. And you can see also, even from the performance of the listed companies, they have done exceedingly well. So I think there's a lot of room for growth within the African context. And I think if we can just do these basic reforms one at a time, we should certainly see more direct inflow. Especially, I think Mr. Chukwu also touched on that. Volatility of exchange rate poses a concern for anyone, both domestically and internationally. So it's very important that we have some bit of stability, and one of the ways to guarantee that is to actually have uh, more on the export side than on the import side as an economy, and that will help stabilize our economy and stabilize the exchange rate and attract more international investors into the country.
Yeah, thank you so much. Round of applause for Jude. Thank you so much, Jude. Let me come to Professor Uche Waleke. Yes, so you've got an economy that got sick and got taken to the hospital. So, well, technically from a medical point of view, so well, okay, 140 reading is the healthy blood pressure level. So it goes to 400. You say, oh, you're gonna die, you're gonna die. Okay, let's stabilize it to 140. 140 is not an ideal level. I say it's stabilized. But 107 is the ideal blood pressure level. So if the patient is stabilized at 140, would you say the patient is out of danger? So one single reform or two, I'm not sure they're enough anywhere to fix it. So what other cocktail of reforms do we need to have to drive investors' confidence, to drive capital flows, and to not just please investors. Mr. Johnson Chuku is not going to be happy with me, but not just to please investors, but to please the rest of the economy as well. Ensure that we get more productive because we need it as well.
You're very correct, Wasim. First, again, let me thank Cowry. Of course, I'm part of Cowry for making me part of this.
You are the only one wearing the Cowry tie here.
Exactly.
Not even the group
Exactly.
CEO.
Part of this economic discourse. Thank you. So, Wasim, that has always been my point. I've had this argument with colleagues, even in the university, about what comes first: is it stability or growth? Yes, I agree. There's need for stability, but again, the question is stabilizing at what price, at what equilibrium price? Okay. Yes, exchange rate at 155, 50 or 1510 is appears stable. Okay, but again, at what price are we getting that? Okay, so but the point remains anyway that stability is also necessary. Because if you look at what has happened, again from the presentations here, despite the turbulence we saw in the first half of this year, despite the turbulence, the Nigerian economy would appear to be, resilient. And if you also stretch that further, you can also agree with me that the Nigerian economy has, to a large extent, outperformed expectations. If you look at inflation rate, for example, just as we saw, we are beginning to see some level of disinflation. 22.9. Okay, even if you ignore the fact that at some point it was rebased. If you also look at GDP, again we hear the new GDP figure, the rebased figure will be out before the end of the month. GDP growth rate last year, 3.4%, and the first half of the year we also seen relatively strong GDPs despite the turbulence that we've had, in the global economy. And again, from what the figures we saw, the current account, balance is surplus. And if you bring that again closer to our markets, you can also, clap because the Nigerian stock market, has also outperformed even that of peers. I was looking at the Morgan Stanley index for emerging economies. If you look at year-to-date return, it's less than 20%. But here we are doing 22, percent. So far, market cap, equities cap at for the first time touching 80 trillion. Okay, bond fixed income at 51 trillion, and exchange traded funds, size today at about 27 billion. So if you take all that into cognizance, you have close to 80 something trillion, in terms of the market cap. Okay, as a percentage of GDP. It has even gone beyond what we have in the capital market master plan, which is 20% by 2025. So we now have 38%, thereabout, as a percentage of GDP. If your GDP is say $250 billion, now what all of that shows is that the Nigerian economy has appeared resilient, and resilient on the back of the reforms that we've had. On the back of the fact that fuel subsidy was removed, on the back of the fact that again on the monetary side exchange rates were unified, and part of what he has said, I'm sure many of you saw the IMF recent Article 4 consultation report on Nigeria for 2025, where most of these things also appeared. IMF commended Nigeria for these reforms, but IMF was also quick to note that those reforms, are yet to translate into tangible gains, for all Nigerians, and for me, that is where we should be headed. Yes. So, talking about the level is still high. Okay. So we need to also do more to see how we can further bring down the exchange rate. For example, we need to also do more in the area of just as the IMF advised. Okay. Spending quality. We have done a lot now in the area of domestic revenue, mobilization in terms of the Nigerian Tax Act. Okay, what remains to be seen, what remains to be done, should also be in the area of spending quality. Okay, so the IMF also touched on that. Spending quality is important, and when we talk about spending quality, we are talking about spending, just as he said, education and health, very critical. So we need to do all of that, to be able to have an environment you can say that is truly business friendly. So I want to see those reforms in the area of spending, in the area of also debt. Investors, remember, investors are very conscious of the consistency in policy. Investors are also conscious of predictability. They should be able to predict what happens next. So going forward, I expect the central bank, for example, to use more forward guidance, and also to, just as IMF advised, to have a rule-based intervention framework in terms of their forex management, so that they don't adopt ad hoc interventions only when to smooth out the volatility. Let me leave you with this quote. Volatility is a tax on the impatient and is a reward for the disciplined. So as much as possible, we should try as much as possible to reduce volatility.
Thank you.
Thank you.
Please put hands together for Professor Waleke. Thank you. I really appreciate that. Let me just tell those who are online to please go ahead and send in their questions. We'll take a couple of them online for my panelists. This morning, the IMF reportedly told Ethiopia that the black market rate, the gap between the official and the black market is now about 17%. After they did the currency realignment from around 84 to about 135. Now the black market seems to be, I think they're getting into some hot waters, as it were, that comes with exchange realignment. But I got good news from Ghana because the president says there will be no further fuel allocation and fuel, what do you call it? Fuel allotment to fuel official. All political appointees, no free petrol in their vehicles any longer. They just have to go to petrol stations and buy with their own money. I want to cut cost of governance. Isn't that good? Nobody's clapping. Okay, well, maybe. But let me just ask the Dr. Muda Yusuf about how small and medium enterprises can thrive in this environment, how to remain agile, how to remain profitable. Are there practical strategies? You spent most of your years with the LCCI and now with the CPPE talking to private entrepreneurs and the private sector people. We have inflation, we have forex instability, well, maybe a little bit of stability in terms of what the numbers is, but not where we were 2023 January, in the manner of speaking, and a weak purchasing power. Someone came out this morning on Twitter and did a table of 5 products: meat pie, chicken, what's the other one? I think about 5 of them, and just try to compare their prices between 2017 and 2025, and salad and a few things, and I'm looking at between 300, 400, 500% increase. So if I'm in that business, how do I survive? Give me some advice.
Well, thank you very much, and let me also thank Cowry Asset for this opportunity. First, before I answer that, let me just make a few remarks on the macro environment, because the picture is not looking as good as we thought. Because when I looked at the figures of our fiscals in the central bank report, I don't know whether there are other data, the revenue performance has been very, very suboptimal, especially from the oil sector. In 2024, for instance, we had a revenue projection of close to 20 trillion. And when I looked at the numbers, we had seen revenue actual as at the end of 2024 of just slightly less than 10 trillion. So that is almost 50% less than what we expected. That of course is very disturbing. And when we look at the ratios, particularly the debt ratios, also very, very disturbing. Contrary to what we have been hearing, debt ratios are getting close to 80. In fact, there was a quarter, it was over 100% debt service to revenue. So if you have that kind of picture, that is a major risk even to the macro stability that we have been celebrating. So I think we need to watch it properly, and so that we don't end up creating a lot more challenges. And it's also important that we have what you can call fiscal realism. We have to be realistic with our budget, so that you don't have this wide gap between what we budget and what we actually deliver. That gap is getting embarrassingly very wide. I think it's something that we need to address. And we also need to make the economy as inclusive as it can be. Because when you look at the economic landscape today, apart from those of us, and many of you are here in the financial markets, and maybe the politicians, many other sectors are struggling. They are struggling very, very seriously because of cost. Because cost has increased so astronomically that it's extremely difficult to pass on this cost to consumers. And that is squeezing a lot of businesses, So having said that, of course, those are the challenges that the SMEs have been facing. When people say they are not seeing the benefits of the reforms, the SMEs fall into that category. That yes, a lot of sacrifices have been made. Theoretically, there have been some stability here and there. But in terms of real impact on their own bottom line and on the welfare of the people, that is still a very big, big issue. So generally, I think for SMEs, it's about, reviewing their business model, because there's a lot of disruption. We look at that, how they can, address that. The CEO of Cowry has talked about scenario planning, look at the various scenarios and all of that, and also reduce their exposure to bank debt. Interest rate at 30% is suicide for anybody. So if you are running a business, I don't see how you can use credits at 30% to run the business. I don't see how one can break even. So as much as possible, whether the SMEs will go and see their uncles or their politician relations to help them with funds, that perhaps is what is more sustainable. And again, it's also to look at energy solution. Energy solution is a very, very key issue for the survival of businesses. Spending money on diesel, on petrol is becoming, very difficult to sustain for many businesses across sectors. So looking at better energy solution, I think, is key. Avoiding bank debt, I've mentioned that. So these are some of the things I think the SMEs can begin to look at, and also looking more inwards in terms of sourcing raw materials. Because the more you got exposed to foreign exchange, the more challenges we have. Because if there's an exposure in Forex and you are earning money in Naira, it's very, very difficult to align. So let me stop there. I think those are some of the things that you can be looking at in terms of survival strategies for SMEs. Thank you.
Thank you, Dr. Muda Yusuf. Thank you so much. Let me just go back very quickly to Mrs. Yinka Delekam, because of your experience of at Augusto and Co. In terms of your okay, very quickly. Let me just take this from one of our online participants. Is it possible to grow the tourism and agri sectors when insecurity and poverty are on the rise? For GMD Cowry. Mr. Justin Chuku, from Participant with Love.
Well, the insecurity is a clear challenge to any sector of the economy, not just tourism, not just agriculture. Of course, we've seen the impact of insecurity in the agricultural sector. We've seen farmers in the food belt of this country, that's Benue, Plateau, Taraba, displaced. In fact, as we speak today, if you look at food inflation in the country in the month of May, food inflation was highest in Benue. And Benue used to be the major point where we produce food and distribute this country. So clearly, insecurity is a challenge to food production. insecurity is a challenge to tourism because the tourists must be comfortable that they will be safe. They move around, and that's why I think it was Jude that spoke on insecurity. So the issue of insecurity security challenge in the country cannot be overemphasized. The government needs to do everything we have to. I mean, I was talking to somebody last week, and he said to me that when his in-laws came, in-laws are Europeans, that they drove to Yankari Game Reserve. And then went to Spain, and those in-laws have been asking to come back and make another tour to Yankari Game Reserve. Clearly. So the government has to do a lot. So it's going to be, it's a drawback. It's a limiting factor. The insecurity in the country is a limiting factor to developing the tourism industry as well as expand agricultural sector.
And that's thank you, Mr. Johnson Chuku. I hope and that is quite true. I'm sure Mr. Jude Chemeka, who sits at the top of the Nigerian exchange, can tell stories of some of those agro-allied companies, Okomo Oil, Presco. They got thieves going there, attacking some of their security men on those farms and plantations. Some of them had to pay some. So it's quite tough. It's quite very, very tough. But we have to keep moving the needles, and as it were. I think we can look at areas maybe where there's less insecurity and focus on those areas very quickly, make some inroads, and while we deal with insecurity at other parts of the country. Mrs. Ade Leka, I was about to ask you the question about if there are, in terms of risk and stability, are there learning curves across sub-Saharan Africa that you think we can leverage on in terms of what we have done in terms of the macros, and now we can allow this to begin to trickle down? If you look at countries with high unemployment numbers like South Africa, that's what we call the most advanced economy on the continent, dealing with high level of unemployment and inability to transform or to allow the big financial services or the banking sector, and it's still even difficult for small businesses in South Africa to make to get credit from the system. So what can we do, because we need to allow small businesses make inroads, and what else can we do within the financial service space?
Okay, thank you. So when you asked me the first question, I wasn't going to review Johnson Chuku, my long-term professional colleague's presentation, but I think I'll talk a bit more, and I really thank Johnson Chuku for the invitation today. So when you talk about small and medium enterprises, I would categorically say that an Augusto & Co. that has branched out geographically is a small and medium enterprise, if you can call it that, because we're not as big as the banks, we're not as big as other big financial institutions. But I'd like to look at things from a positive angle. And I do not like to dwell a lot on the negatives, because I also believe that there are huge opportunities for many businesses in Africa. And what would I tell an investor to look at? First and foremost, try and understand the political ideology of whatever country you're going to, the ruling class. And what do I mean? If you look at Nigeria today, and you look at us from the era of democracy, 1999, we've had various political ideology. But you'll find out that in the periods where we had pro-market political ideology, Nigeria as a country where various sectors have thrived. But in periods where we have the statist economic view, those are the periods that there have been dissatisfaction in terms of various impacts on various sectors. So when I say to an investor who is going into any market, whether it's a small and medium enterprise investor, I would say to you, first you need to understand the political ideology of the ruling class. Secondly, political stability in those markets. And a critical factor is the long-term inflation rate. Now, when we decided to branch out to other African countries, one of the parameters we looked at is the long-term inflation rate. And why is it important? By looking at inflation, you will see the impact on various macroeconomic prices, whether it's the interest rate, whether it's the exchange rate. Now, when we decided to go into East Africa, what was the main driver? We look at those markets and we realize that the inflation rate was between 3 to 6% in terms of long-term inflation rate. If you look at Nigeria today, historically Nigeria used to be 12. But if you look at Nigeria today, we're looking at a high of 17, 18%. And it makes it difficult to invest. Why? You're having to contend with high interest rates, which is what we're seeing now, exchange volatility, which is now been tapered. So you find out that you have to go and diversify, which is what Johnson was talking about. Go into other markets whereby the prices, the interest rates, the exchange, there's more stability. And so the decision to go into those markets, if you look at markets like Togo, Cape Verde, we're talking sub 3% inflation rate. If you look at today, Tanzania, Uganda, Kenya, the East African zone, we're looking at between 3 to 7%. And then if you look at West Africa, maybe us and Ghana, then the story is totally different. So my own response is, are there opportunities? There are clear opportunities. How do we recognize them? By being deliberate to look at these various sectors. Another part I would look at when you want to make informed decision is to look at the banking sector, the health of the banking sector. And if you look at Nigeria today, and you look at our banking sector, and you strip out depreciation of the Naira last year, you will find out that the growth in terms of loans has not been significant. And that's a telltale sign. Why? The banks are cautious. They still tend to see that there's a weak macroeconomic environment despite the reforms. So when you strip out the growth rate of maybe 34%, which is what it was in 2024, we're looking at, by the time you strip out depreciation, we're looking at less than 7% growth rate in the banking sector. And so that immediately tells me a story that yes, things have improved in terms of reforms, but there's still a cautious approach to lending, and that's because of the high risk element. And that goes to Mr. Yusuf, what he's saying. The SMEs are struggling, they're definitely struggling, and their ability to absorb shocks is not in the same category as what you will see in terms of the large corporates. And that's going to be our story for the near term, unless there are fundamental changes in the economy. Thank you.
Thank you, Mrs. Yinka Adelekon. Thank you very much, Adelekon. Thank you. We appreciate that. Let me just quickly ask Mr. Jude Chairmaker. It's been a very good half year so far. I'm sure everyone in the room has made money, with the exception of myself. I just want to find out how much more headroom do we have for the rest of the year, and where's the consumer goods rally coming from? Yeah, the banks, we can understand the whole movement around recapitalization and the deadline for end of March next year. So what's changing in the market? What can we look forward to? What can investors look forward to, whether they're retail, institutional, for the second half of the year?
In as much as I would like to stay and take that question, unfortunately, I wouldn't be able to. But I have my colleague, Mr. Abimbola Babalola, who heads our trading and products, who is equally vast in the market, and he will be able to take that as I have to engage some of the internationals that we've been trying to court for a while now. Thank you so much for having us here today.
Please put your hands together for Jude Chairmaker. Thank you very much. Thank you for coming. Thank you. Mr. Abimbola Babalola, please take that seat and let us know how much Jude Chairmaker is pursuing in USD terms. Please, let's be the first to know. And where the money is coming from.
Sorry, please, the question again.
So we'll look at the first half. The first half was has been very good. Has been good. The market is done well, even in US dollar terms. So what's the outlook on the second half of the year? We're already in July.
Yes, thank you very much. I think if we hope the reforms are still there, because if the currency is relatively stable, and I think there's a projection, I mean, good thing, we have it's now a range. People can say the lower limit and the upper limit for the exchange rate. We also hope that we're going to see quality listings in the second half, especially the Dangote, fertilizer is coming, the petrochemical. With that will provide opportunity for people to reappraise their portfolio and also diversify, with the hope that we also hope that we're talking with Mofi, that government had a lot of assets. Now the market will give them proper valuation, and if they can continue with some of the privatization. Even there are companies today that it's not as if government has fully diversified. Maybe they own 10%, they own 15%. They can realize additional revenue by releasing some of those quality assets. We're working with Bank of Industry, to also work with them. Some of the portfolio that they have, Bank of Industry provide a single digit interest rate to some SMEs. So our own relationship, that arrangement is to come in, work with them with the hope that we prepare those SMEs that if they need additional capital, instead of going to the banks, they can start looking at capital market instruments that will not be as high as 30%. And I think one instrument that I think they might start looking at is what we call these preference shares instead of the equities that people know. The preference shares is there. I can agree with you that you bring in your capital. We agree as to how much I'm going to pay you in terms of dividend, and we can use that to grow. Then if you, because I'm looking at, we're also waiting for some of the corporates. By the time they start releasing their results, I think that will go a long way to give people basis to either justify the current prices, because like today, security are sitting at a particular price based on an assumption. So when the half-year results start coming, it's either they are confirming, people's expectation, and that can also drive some of the things. And then a lot of things we're also doing in terms of integration, opening up the market, bringing in more instruments into the market. When you do all this, it gives people, because compared to what we've experienced in the past, once there's a bit of volatility, people will exit. And what impacts the market negatively is if they are exiting and there's no way of them coming back. But if they are exiting from this sector, moving into another sector, it provides that stability. And when the corporate result that we're expecting comes in and they are good, then you'll see the market sustaining what we're currently seeing. And like Mr. Johnson Chukwu said, that today we're 22, the projection is we will get to 30. I see us even getting to 35. Thank you.
You can see the smile on him. It's very positive. Let me ask you, Professor Uche Waleke, and I have the privilege of being in, you admitted me to a WhatsApp group of the academics in, so I'll just get honorary professor sometime soon. but give me a sense of the academic community when it comes to the market and what they think. You interact every day with the professors and those who are retired, not tired, those who are tired, not retired. What's the sense that you get interacting when you deliver these lectures? I'm sure you have one in another 1 or 2 days as well with others. What's the sense they have about the market and the economy out there in the academia?
Thank you, Boasen. First, before I speak to that directly, let me also say something that is tangential to what I think she was saying. I had mentioned earlier that yes, the first quarter of this year, the economy witnessed relative stability, on the back of the reforms. And that has had the effect of reducing our country risk and also reducing Nigeria's, risk premium, if you understand what I mean. The risk premium is the difference between your yield, your sovereign bond yield, like the Euro bond yield, and the yield of the U.S. Treasury 10-year bond. Today, the U.S. Treasury 10-year bond is around 4.48%. And if you look at even the Euro bond that will be maturing in November, we have 1.1 billion dollar Euro bond of mature in November. The yield has come down to as low as 5%, so meaning the price has gone up. So the risk premium has narrowed considerably, and that's on the back of what has happened. So you can say to a large extent again, confidence in the economy has largely improved. But
Professor,
again,
may I respectfully cut in?
Yes.
Before you go to the other question. Yes. And that's the good news, and I just want to back you up. For the first time in the last 10 years, and the report was out yesterday that Africa has, for the first time, seen sovereign risk premium decline. For the first time in a decade. And according to that report, according to data which was released 2 days ago by, I think, a JP Morgan Chase, and also supported by another international financial institution, is the fact that because of the reforms, some of them from the IMF, and domestically modeled reforms are working across Africa, that for the first time, our premium as in a distress that takes us, in which you risk, and you say, look, there's a risk here because we're going to deficit, has gone down for the first time in 10 years for Africa. Can we clap for ourselves?
Yes.
That's some good news.
Yeah.
So which means all these reforms we're talking about are beginning to work.
Yes.
So the risk premium is
Yeah, yes.
please go ahead, Professor.
Yes, but we also need to, translate them. Just as has been observed too, the cost of borrowing is very high. MPR at 27.5% is still very high. And the IMF recent report is saying that the central bank MPC should continue to tighten monetary policy, if you read that report, that it should continue to tighten monetary policy in order to maintain a positive real interest rate. Okay, today inflation is at 22.9 and MPR at 27.5. So you have a positive real interest rate. So the IMF is saying maintain that positive real interest rate because that's what is attracting the investors. But again, locally, we know, just as Johnson mentioned, is becoming difficult, and he also mentioned it, Dr. Yusuf, the cost of borrowing. So for me, while it makes a lot of sense to have the Fisher effect, maintain positive real interest rate, it's also important to see how we can get SMEs access credit, through other means, maybe through our DFIs, strengthen our development finance institutions, the Bank of Industry, and so on, so that they can also lend to these SMEs, given the fact that the cost of borrowing is high. MPC is meeting on the 22nd. Johnson said he hopes that, he's from the presentation, the second half witness an expansionary monetary policy. But I have my doubts, going by what the IMF has advised. So I don't see them, reducing monetary policy rates when they meet on 22nd. So they may retain it, even if they are going to do any expansion, okay? Or if you like, relax monetary policy, that be next year. But for the next, for this second half, I see the MPC maintaining the rates, at least in line with what the IMF, has advised. Now, academic community, yes, academic community, as you know, of course, very much interested in what is going on. But again, if you are talking about particularly the student population, the level of awareness of particularly the capital market awareness is still, low. I can tell you from experience, it's still low. So among the academia generally, we still need to do some real, sensitization to get them up to speed with what's happening in the capital market. I think that's what I can say for now. But a good number of them, particularly those that are members of my association, Capital Market Academies of Nigeria, of course, are very much aware, are very much in tune with what's happening. Many of them are also investors in the market.
Of course, they should be. I see their names.
Yes, yes.
I see their names. I'm sure they're very deep. Yeah. This is a political. Thank you, Professor Uche Waleke. Thank you so much for that. This is a political question, so I'm going to ask the only politician on my panel, the one dressed as the politician, Dr. Muda Yusuf. Yes, and the question from Chika Chukudile, who's online, is what is the impact of early exposure to 2027 presidential election with all the coalitions of political parties and the response of the ruling party with regard to development?
Well,
what am I hearing in the room?
I think we all know the implication of that. It's already causing a lot of distraction. Because if halfway into a tenure of an administration, we are already seeing this kind of momentum in the political space, is something that should worry all of us. And this is how it's going to continue. So there is a very high risk of distraction. Economic issues are likely to take the back seat. And even some of the reforms may lose steam, even this tax reform. Because, you are talking of commencing implementation in a pre-election year. by the time the politicians begin to analyze the tax reform and the implications for political costs, they may have to begin to review some of those reforms. You know, so Professor Walike, you are a member of that committee. I think in your implementation, this is something that also you will need to take account of. But generally, I think it's a major distraction. It's likely to affect a whole lot of things. I've just mentioned that our fiscals are not looking as good as we have been, claiming that it is. And some of these reforms, especially the tax reform, may not go as fast and as effective as it's likely to go. Because by the time you begin to ask those in Oyingbo market to talk about tax returns, you go to Alaba market, you go to Sabongiri market to be talking about whether they pay tax. I mean, the political consequences will be huge. And you may now begin to think whether you should actually go on with this tax reform or not. So we need to. So these are likely to be some of the political consequences. And having said that, let me also say that we are not addressing enough the role of trade policy in fixing this economy. There is too much emphasis on FX, on interest rates, on FDI, on portfolio flows. But when we talk about the real economy, trade policy is extremely very critical because it affects the cost of inputs. So when you have a situation where the custom is under pressure to meet targets, revenue targets, and you have an economy where quite a number of the inputs you require to produce in the economy are also imported. Those things create a lot of contradictions, and it puts a lot of pressure on those who are in the real sector of the economy. So I think we need to look more critically at how we can deploy our trade policy instruments to be able to support the real sector of the economy so that they can cope with some of these headwinds that we are dealing with. And we need to be a lot more sensitive about the social context in which we manage the economy. It's extremely important because we are in an economy, we are dealing with people. So if there is such a high level of social discontent about the economy, we need to be very careful. We need to look at it critically and how we can take some deliberate policies outside the conventional, economic policy management framework to address these social concerns in terms of the economy. And finally, we need to be deliberate in looking at the incidence of market failure. Market cannot fix everything. So when we recognize market failure, it is the responsibility of government to step in to correct incidence of market failure. That's extremely very important as we progress. Thank you.
Thank you, Dr. Buna Yusuf. A round of applause. Let me quickly take this to the group managing director, Mr. Johnson Chukwu. If you think, based on the political sing-songs all around, is it too early to begin to, as an investment bank and investment strategy, to begin to think of the political risk and what the impact could be going into 2026 if the political environment is getting this hot already? And what do you think? How do you think investors should position for that? I remember what Professor Walike said about how to define volatility. He says a tax on the impatient, but the reward
to the disciplined.
To the disciplined. So should I be greedy or should I get scared?
Well, I don't think fear is not an option. I don't think the issue for business people is to be held back by fear. The first thing you need to do is look at your scenario planning, which I mentioned earlier, and ask yourself, what do I foresee that will happen in 2026, 2027? So you look at who are the gladiators, what are the probabilities of each of these alternatives triumphing over in that election, and then you plan your business and say, look, if this happens, then I will do this. So it's like conditional statement. And then in your planning, you're saying, okay, look, today you can actually say on the balance, of course, nobody knows tomorrow, that it be the contest between the incumbent and either Atiku or Tinubu or Obi or Amechi or who else. And if I said it's not contested.
Or someone else not yet known.
Yes, or someone that's not yet known. But so you are saying, okay, so in that wise, who is likely going to win? And then you plan and say, if this wins, what are the policies that can emerge? And then if you do that, you are likely going to have a model of your business that says allows you to survive under any condition. So in that case, you have to diversify your assets distribution and say, look, if this person wins, this will grow and this could suffer. And if this person wins. But interestingly, I think we're also moving to a period, apart from a statement I saw today, was it today? Where somebody said that if ADC wins, they will reduce the price of fuel. I don't know whether any of you saw that. Somebody said they're speaking for ADC, and they said if they win, they reduce the price of fuel.
Is that a campaign?
Can I do a follow-up?
Campaigning already.
So, but ordinarily, if you look at the gladiators, you will actually believe that they are mostly private sector oriented economic thinkers. So we're not likely going to go back to a statist economic environment should any of them emerge. And as time is approaching, you will also see which of the options is likely going to win. But the key thing is that you need to, in your plan for what will happen in 2027, because in business, there's almost no business you can start today and it mature in 2020, earlier than 2027. Particularly if you're going into this sector of the economy. And then I always advise businesses to, as much as possible, avoid getting entangled with politics. If you can, stay away from politics. Because once you get entangled directly in politics, you're going to get the benefit, you're going to also be ready to bear the cost. And the cost can be very huge.
A follow-up. Can I do it?
Yes, please, Professor.
Okay, yeah, thank you. Now, that investment strategy Johnson is talking about also depends on, of course, your financial objectives. What are those financial objectives? Is it capital preservation, or is it income generation? Okay, or is it liquidity? If it's income generation, for example, of course, you will that will now influence the type of investments that you do. Of course, you'll be expected to invest in, for example, if you are investing in shares, companies that have this track record of paying dividends. Okay, so if it is liquidity that is your objective, of course, you know that the money market investments are there, treasury bills and the rest of them. And of course, it will also depend on even your risk exposure, the assessment of your risk exposure, whether you're dealing with the inflation risk or liquidity risk or currency risk. So all of this will influence the way you invest. When I came here the last time, last year when this kind of thing held, I spoke about the DHL approach, which is D stands for diversification, which it has mentioned. The H stands for the hedging. Okay, when you have volatility, particularly currency volatility, you try to hedge. Okay, then L stands for long term. Capital market is about long term. There is this saying, this popular saying in the capital market, that it is time in the market and not time in the market. I'm sure you've heard it. What matters is time in the market and not time in the market, because you can't have consistent results when you say you want to time the market, knowing the best time to enter or the best time to exit. What matters is time in the market. Okay, staying long enough, to smooth out any, volatility, impact of volatility on your returns. I think that's the point I want to make there.
So as we begin to wind down, and just take about for a minute, how do you personally make financial decisions when the economy feels unpredictable? Do you lean on instinct, structure, or timing? Mrs. Adeliko.
I will lean more on knowledge. I listened to Professor speak and he talked about timing. And if we've been in this market long enough, like I have been, I remember buying a banking stock in 2007 at 27 naira. And you all know what the exchange rate was. Before I could say Jack Robinson, the bank was acquired by the federal. And before I knew it, I got some dollar transfer share certificate from a Pan-African bank. And before I knew it, I was holding nothing. So sometimes, yes, timing is good, but what is more important is knowledge. You must be able to determine companies with good corporate governance, because corporate governance will determine the long-term game. If you look at banks that have survived in Nigeria today, the banks that have strong corporate governance will continue to give you the kind of returns that you want. That's the critical thing. If you play a timing game for a company that has no strong governance, no strategic business model, you will be holding nothing. So what is clear to me, very clear in Nigeria, knowledge is critical.
Interesting.
Understand the sector,
Interesting.
understand the management, the horizon, the ideology, and then make informed decision. And that's what will make you survive in this market.
The playbook of Warren Buffett. Yes, yes. So that's out of the playbook for Professor from Warren Buffett. I'm sure Professor will agree, because again, you have to eat what you know and know what you eat. I think that's basically knowledge. Knowledge is everything. Let me pass that on to in terms of what retail investors should look out for. Now I'm talking about folks like myself, the retail end of the bottom of the pyramid. Why is knowledge of the market important?
The lack of knowledge is ignorance, and if you don't have it, you're going to lose all your investment. So normally what I advise people, especially people that are new to the market, the company you want to invest in, they produce a product or they provide a service. How acceptable is that product? Is it a product that I cannot do without? A product that my neighbors cannot do without? That millions of Nigerians cannot do without? That tells you how strong. Or is it a service that people will have to consume? Is a must, whether you like it or not. So you take that into consideration. The next thing is you go into the management, the company. What are their raw materials? Where did they source those materials from? Is this something that they have to import, or they source it locally? You analyze that. Where is the market that consumes their product and services? Is it local or is it foreign? I think you mentioned Okomu, you mentioned Presco. I think in the last 5 years, I've always been telling retail investors, the reason why the British or the Europeans came to Nigeria is because of crude oil. No, palm oil, not crude oil. That is why the likes of Okomu, because they produce a product that is not only consumed in Nigeria, but that they have to export it. So when Naira is devaluing, you expect the value of such a company to be going up. Now, by the time you're done with this, you need to talk to your investor, the advisors, because I've looked at these fundamentals, I've looked at this company. I don't want to, re-emphasize it, but corporate governance is also something that is, without corporate governance, even if the company's fundamentals are good, their numbers, people will use the back door to rob the investors of the value that is embedded or inherent in that company, because somebody is not doing the right thing. So corporate governance is good, and empirical evidence has supported that. Once you have a corporate governance, a company will turn a liability into an asset, and it will give a better return to investors. So constantly read research report, talk to your brokers. And I always say this too, in the local palace, we have what we call local intelligence. We also replicate it to everywhere. Yes. I recall when we were on campus, Yaba Market was very close to us. We know when to go and buy things in the morning. And we know when to go to buy in the evening. And as we're doing that, we're also looking at psychology of the sellers. You can see somebody who has not sold anything for the day. What I'm saying here is, don't I know people, I always advise them, make sure you have 2 or 3 financial advisors. I've done my own analysis. I'm talking to broker A. I want to buy AB. Tell me why I should buy. I'll talk to broker B. Maybe broker B is saying buy BC. I'm asking the other broker, why are you not recommending C? I'm gaining knowledge. Because the other guy will explain to me, or is either he confirms that, oh, whoever recommends that for me is also saying the right thing. By the time you bring all this knowledge together with what you know and with all the data, research, one thing is this: the difference between Africans and the developed world is embedded in data. And data is research. Once you constantly look at data, it will tell you the direction that things are going and that things are not, people just wake up and you see things moving. We were challenged when people were asking us, how did the index grew from below 20 to over 100? I said, but did you look at the track record? This was achieved over 15 years. So it's not by accident. It was there, gradually moving and progressing. So when if you research and you continue to do research, you always see value and opportunity investment opportunity that you can take advantage of. Thank you.
Thank you, Babalola. Thank you so much. At least in the room, we have about 7 or 6 Cowry Asset officials. So if you ask Mr. Johnson first, and ask Mr. Sonny second for his own, what you should buy, you ask the other person. At the end, the money stays in the fund. Closing thoughts. Oh, by the way, a barrel of oil is about 68, crude oil is about $68 a barrel. Have you checked the price of palm oil?
It had dropped further.
Sir?
Crude had dropped further today.
It's about 68 as of yesterday for Brent, last night. Dropped further today. Oh, thank you so much for that update. So palm oil is about $970. That man is interested in buying. Wants to know whether it's buying or buying. That's how to make money. That's knowledge. You come to me and ask. Okay, Dr. Buda Yusuf.
Yeah, thank you very much. Well, my final thoughts is just for us to pay closer attention to our fundamentals, macroeconomic fundamentals, particularly our fiscals. As we project, we have to project realistically, so that we don't have either budgets or fiscal operations that will pose a threat to macroeconomic stability. Our debt levels is very concerning. The debt ratios are not looking so good. Even if you rebase the GDP, the reality of the ratios to revenue will still be there with us. So going forward at the macro level, I think we need to be very, very realistic in our fiscals. And secondly, is for us to ensure that we have the right kind of regulatory environment to support indigenous players. Before I got on to this podium, I had a discussion with one of the participants, and he was telling me how the Chinese have taken over the sector completely. And this is being replicated in a number of sectors. Yes, we need foreign investment, but we should also have a design to ensure that indigenous participation in the economy is also key, because it's very easy, to overlook that, in the furia that you have foreign investment. But indigenous participation, we should have a deliberate strategy to ensure that we mainstream our indigenous players in all critical sectors of the economy. Thank you very much.
Thank you so much, everyone. Thank you so much. Let me give Mr. Johnson Chukwu just 30 seconds to wrap up, and I say thank you to my panelists. We have the vote of thanks and the closing remarks.
Okay.
Okay. I'm sorry, Professor, for overlooking.
Thank you, boss. Closing thoughts. Let me speak to retail investors. When I talked about timing, timing works for issuers. Many of you know about the market timing hypothesis. Market timing hypothesis by Baker says that companies issue shares when they feel their shares are, overvalued. That's when you issue. That's when you're likely to be successful. But from the point of view of retailers, timing is not, advised. Just as she said, what matters is investing from the point of, knowledge. And that's why I teach what most of the time what I tell my students is what matters is the EIC approach. EIC means economy, industry, company, analysis. That is what should inform, how you invest. And particularly for retail investors in periods of uncertainty, it's also advised you do what is called dollar cost averaging or dollar cost investing. What that means is that every month, for example, you invest, a specified amount of money. Okay, you can approach a mutual fund and then commit, say, 1 million naira on a monthly basis, regardless of what the situation is. That way you beat, uncertainties, and you stay, again, as I said earlier on, you stay on it for a long period of time. So for investors, consider dollar cost investing, and then also for you can also, I also talked about here earlier, the DHL approach. Remember, diversification, hedging, and long term. Thank you.
Seconds, can you give that to me?
Okay, what I would say is that the government has actually introduced a couple of reforms. We talked about the removal of subsidy on forex and removal of subsidy on petroleum products. We talked about the new tax laws. But then, one, they need to stay the course. That's going to be a challenge as the election is approaching. Two, we need to address the issue of decline in standard of living of citizens. And that major factor, if not addressed, could push back on whatever reforms they have implemented. So in terms of GDP growth rate, we think we're going to see some improvement in growth rate. We're going to see some stability in exchange rate or some level of even appreciation. We think inflation will moderate, but the moderation, because income may not increase even at the rate of the reduced inflation rate, standard of living may continue to deteriorate. And like I said, if that is not addressed, it could be a major pushback to whatever reform are taking place. And we cannot overemphasize security. We can actually say 10 times security, security, security. If we don't address the issue of security, we're not going to address the issue of food production. And the average household consumption is largely food dependent. So, and that's one shortest route to improve living standard of Nigerians, if we can bring down food prices by ensuring that farmers can go back in their farms to produce. Those are my close comments. And once again, I thank you all for coming.
Thank you. A round of applause. A round of applause for my panelists. Please stand up for a group photograph. Please, thank you so much, Professor Uche Waleke, Professor and the President of the Capital Market Association of Nigeria. Thank you, Dr. Muda Yusuf, the founder and CEO of the Center for the Promotion of Private Enterprise, Mrs. Yinka Adeleko. Thank you so much. From Augusto & Co., the Managing Director, Mr. Abimbola Babalola from the Nigerian Exchange, and of course, our very own Group Managing Director and CEO, Mr. Johnson Chuku. Thank you. I think the vote of thanks was to be given by Professor Kalu Christopher. Yes. Is Professor here? Oh, okay. Sorry, I think we're going to refreshment. I forgot I was. Oh, Daniel. Oh, please come, Prophet Daniel, to give the vote of thanks. formally on behalf of everyone, and in particular to our online participants. And after that, there's a light lunch and networking at the foyer.
Thank you, everyone, and it's been a pleasure. Good evening or good afternoon, distinguished guests, colleagues, and friends. As we come to a close of this inaugural Cowry quarterly economic review for the first half of the year, allow me to sincerely thank you all for being part of this timely and thought-provoking conversation. Today's discourse has reminded us that while economic volatility is a global reality, resilience, foresight, and collaboration remains our strongest currency. As we have heard richly from perspective across sectors, from Mr. Johnson Chukwu, who illuminated on institutional investors navigating risks, uncovering long-term opportunities, and also from Professor Uche Waleke, who challenged us to look at the structural and policy level levers required to foster capital stability. Dr. Muda Yusuf, who emphasized the need for private sector adaptability, smarter regulations to support real economic growth, and Mrs. Yinka Adilakan, who deepened our understanding of risk management, creditworthiness, and financial market signals. Also, thank you to Mr. Jude Chiemeke and Babalola of the Exchange, who reinforced the pivotal role of Nigerian Exchange in mobilizing investors and unlocking economic potentials. Each insight here shared today strengthens our resolve not to just survive volatility, but to thrive through it, intelligently, ethically, and strategically. On behalf of the Board of Directors, Management and Staff of Cowry Asset Management Limited, I extend our heartfelt gratitude to our panelists, moderator Bosun Omofe, and of course to you and those online. Thank you for being here. Thank you, our attendees. We are truly appreciative of the time you spent with us, for making this event possible, and for your active participation both in person and online, because this event won't be possible without you. Let us take what we have learned here today and apply it in our personal lives, in boardrooms, classrooms, in businesses, and also on the policy table as we work towards a more resilient and prosperous economy. Thank you once again, and we look forward to welcoming you to the next edition of Cowry Economic Discourse. Thank you all for coming.
Thank you, Daniel. We really appreciate it. And on that note, I want to say a very big thank you, everyone, for coming for the Cowry Quarterly Economic Discourse. It's been a refreshing half day for all of us here. Thank you so much, everyone, for putting it together. Thank you very much to the Group Managing Director and the rest of the team for putting this thriving in a volatile economic environment together. Thank you to all my panelists once again. And of course, we thank our online participants who are sent in a few questions. Sorry, we're not able to take everyone, but of course you have the contact of Cowry Asset Management, so please get in touch, whether on social media, via email, and other forms of communication, so that we can speak with you, get your insight. Of course, there are regular reports and officials of the Cowry Asset Management you can meet one-on-one and also on the phone and via email to get more clarity on the state of the economy and how it impacts your investment in the market. Thank you so much, everyone. Do have a great day, and it's bye for now.